What's going on, you guys? My name is Shiraz Ahmed, and today I'm going to be sharing with you one of the main reasons why most investors are underperforming the financial markets this year. So stay tuned. Okay, so as the economy expands and contracts, so do the financial performances of companies across the 11 stock sectors. When the outlook is positive, economically sensitive companies perform better, prompting investors to buy their shares. On the flip side, if the outlook turns sour, investors may sell out of those companies and swap into ones that can potentially weather the storm and the economic downturns a bit better. This practice is known as sector rotation, and understanding how it works can actually help you become a better investor over the long run. Now, sector rotation is evidenced in its most basic form by the performance of value and growth companies since 2003. Growth stocks, which are more insensitive to interest rates and other economic factors, took advantage of favorable conditions across the last decade and a half and drastically outperformed value stocks. Here we're looking at two ETFs provided by Vanguard that track both value and growth companies. As you can see, both growth and value stocks have trended in similar patterns for quite a while. Yes, while growth has significantly outperformed value since 2003, you can see that they also tend to move in similar directions, just in different magnitude. So as investors, since we can see that they move together, we need to focus on which one, value or growth, will outperform the other. Unfortunately for most, this has been really hard to accomplish in this year. Spiking treasury rates and inflation in Q1 of 2021 caused investors to rotate into value stocks, typically companies with steadier business models. Value outperformed growth in light of the economic backdrop as rotation happened, and given that the higher volume of shares that traded hands. Since Q1, the flip-flopping between value and growth has been tremendous, something that we have not seen in quite some time. So due to this phenomenon, many investors have actually lagged the markets this year. Now, in addition to that, many investors continue to wonder which part of the market cycle are we even in. Knowing this can actually help position portfolios in value versus growth companies accordingly. To help drive this home, here's a chart showing the cause and effect along with which sectors perform best given where we are in the market cycle. Now take a moment to look at this graphic. Now try to guess where we are in the market cycle. And from here, you can tilt your portfolio towards either value or growth ultimately as you see fit. I would guess that we're somewhere in between early and late expansion coming out of this global pandemic, where the market cycle has actually been compressed, meaning that we went in and out of one of the fastest and shortest bear markets in history. So to summarize, this has been kind of a challenging task for even the most veteran of Wall Street investors, let alone your average retail investor. But I'd love to hear back from you guys on the experience that you've had over this past year. It's been a volatile one. I hope everyone out there has been keeping safe. If there are other topics that you wanted to hear me talk about, I'll put my contact information at the end of this video. Please do feel free to shoot me a line, and I look forward to reconnecting with you guys soon. All the best. Bye for now.